Do you know there is a way to understand and interpret the market behavior just by looking into certain information given by the markets without depending upon anyone? Yes, that is technical analysis. By the end of this video, you will have a complete clarity on what technical analysis is, what makes it so important, what is the fundamental belief of a technical trader, and also different types of charts. Hi, my name is Nataraj Malwa, the author of Mastermind of Day Trading. Welcome back to yet another interesting video from Trading with Groww YouTube channel. We are going to upload many interesting and informative videos about trading in this channel. If you don't want to miss those updates, kindly consider subscribing to the channel and also click on the bell icon to get the regular update. Well, let's get started. Bhav Bhagwan che. This is a famous statement in Gujarati. So basically Gujarati people are meant for business. So they say Bhav Bhagwan che. This literally very relevant to our today's discussion because technical analysis is all about understanding the price behavior. And in today's world, most of the people are preferring to go for technical analysis because of the advancement which is happened at the technological part. So if you just look at 10 years, 20 years back, there was no such technological advancement that there was not having an access to the data. But now at the level of mobile, we have all the data to access, and based on that, many things can be anticipated. So technical analysis is all about understanding the price data, basically the past repetitive data. This is a very important point I'm mentioning here. So a technical trader try to analyze or try to understand the price behavior, and he try to find that repetitive pattern, and he try to anticipate the same repetitiveness of the price in the future. And he is not bothered about why market is moving in the way it is moving. So he basically concentrates on the price. So this is what we can call it as a technical analysis, and this technical analysis can be applied to any asset class, be it a future and options or equity segment, currency, commodities. Any asset can be traded by using technical analysis. Now comes the important point. When it comes to the part of some subject or some concept, there has to be some fundamental understanding or fundamental faith or beliefs. So similar to that, in technical analysis also, technical trader have certain beliefs or certain faiths. Based on that, the entire technical analysis is guided. So now let's understand those fundamental aspects of the technical analysis. The first and most important belief of a technical trader or the technical analysis is price discounts everything. This is the fundamental belief of any technical analysis traders. So basically, technical trader believes that the price discounts everything and every information is available in the direct price itself. That's why he considers price itself as the direct indicator of everything. So any particular information, it may be a good information, bad information, or an expected good news or expected bad news, everything has to discount in the price. For example, let's say if a mass or if the majority of the people are expecting some good news in some XYZ stock, so obviously those stock everyone try to buy it. So obviously when most of the people are trying to buy it, price has to move up. So a technical trader focuses on the price behavior and immediately points out that the price is increasing, and it means that the demand is increasing. So he didn't have to study the hefty information that is available in the news or available somewhere else. So he just look at the price and understand that there is a demand. Similarly, if there is any bad news or expected bad news in the market, or if there is any negative bias in the market, obviously that has to be reflected on the price. Most of the people want to sell the market at that particular point of time. There will be a downtrend or downshift in the market. So technical trader points out that downshift and understand that there is a supply in the market. So a technical trader is least bothered about why the price is behaving or why the price is moving up or down. So he basically concentrate on how I can approach or how I should be placing myself with respect to the present context of the market. For example, in which way the market is moving or in which trend it is presently trending, whether it is a uptrend or downtrend or sideways trend, and how can I place my trade, how can I place my trade according to this trend, aligning to the major trend, primary trend. So these are the major questions asked by a technical trader rather than why the price is moving in the way it is moving. Well, the second most important and the fundamental fact or fundamental belief of a technical trader is that price moves in trend. What it means is that when market is moving in a direction, on one particular direction, like it may be an up direction or down direction, it will not move in a straight 45-degree line. So there will be a zigzag movement. That is what we can call it as a trend. So basically what we can call it as a trend is the primary direction of the market is what we can call it as a trend. Primarily, if it is moving in an uptrend or if it is moving upwards primarily, that means it is in a uptrend. So it will make a zigzag movement in a upward direction. And similarly, primarily if the market is moving downwards, then we can call it as a downtrend. You can check out the last 1 year data of the Reliance. You can see clearly that the market is moving upward and downwards randomly, and there is a clear trends between them. So it is moving in upwards, but it is moving a slightest down movements while moving upwards, and similarly when it is moving downwards, there is a slightest upward movement in a downtrend. So basically it means that price moves in a trend. It will primarily move in certain direction, but it will make a zigzag movement in that particular direction. Now comes the important point and important belief of a technical trader, which is history repeat itself. As I said, the technical analysis is all about understanding the price behavior. I want to repeat it, repeated behavior of the price of the past, and based on that he tried to anticipate what is going to happen in the future based on the repetitive pattern that he observed in the price. So history repeat itself is the fundamental belief of a technical trader based on the entire technical analysis depending upon. So in order to understand this part clearly, I want to give you an example. No matter whether it is a good situation, bad situation, whatever the situation we are dealing at the moment, the reaction of us to that particular situation remains the same. So broadly, there are two important dominance forces are there in terms of the emotional part or the reactional part of the human being, which is fear and greed. Because of that, market is moving on a daily basis, up and down movement is happening. So our behavior and our response to certain situations remain the same, and it is going to remain the same in the future. I want to recall a famous quote by Jesse Livermore. He is one of the legendary investor and a trader of the history. So he says that there is nothing new in the Wall Street. So of course we are dealing with the Dalal Street, so we can call it as a Dalal Street. There is nothing new in the Dalal Street. Whatever happens in the stock market today has already happened, and it is going to happen in the future. So this is exactly the quote which is quoted by Jesse Livermore, one of the famous investor and the trader. So it's clearly evident that when some good thing happens or when market is moving upwards, everyone want to buy it. So obviously everyone's response to the greed is remains the same. We want to buy the market, and similarly when there is a panic and when there is a fear in the market, obviously everyone want to sell the market. The reaction of the people for certain situations, especially with the dominance forces and dominance emotional forces which we face every day, is going to remain the same in every situation. So if I want to give a practical example, the recent example which is happened in 2020, the corona hit the market, everything was good. The moment there was a news about the corona, obviously market fell more than 25%, and you know the story. So after that, the market recovered within few months. So this uptrend and downtrend is very evident and typical, and of course predictable in nature. So overall, our human nature is absolutely predictable to certain situations in our life. So a technical trader uses different types of charts, different types of studies to understand the price behavior. So it may be a candlestick charts, it may be a bar chart, it may be a trend line, support and resistance, or a different kind of a patterns like various patterns, triangle patterns and head and shoulder patterns. So there are so many patterns and the methods by which the technical trader try to analyze the market and try to find those repetitive patterns and try to anticipate the market in the same way for the future results. So far we have discussed about the fundamental aspect of technical analysis. Now let's move on to the next step, which is understanding the charts. Charting plays a very crucial role because a technical trader looks into the different various kind of charts and he spot out the opportunities by looking at the repetitive patterns of the price. Charting or the chart is basically the representation of the different data points from a different time frame of the market. Here one can easily plot the different types of charts by using the data points given by the markets. When it comes to the charting, there are three important major chart patterns which are accepted broadly in the markets, and there are so many ways by which you can plot different types of charts once you have the data point of the market. Among these three important types of charts, the first one is the line chart. As we can see here in the screen, this is the line chart. This is how it looks. Basically, it's about connecting from two different data points. For example, let's say market closed yesterday at 10 rupees and today it is closing at 12 rupees. We have two important data points, which is closing price from different two time frames, yesterday and today. So if we connect the dots from yesterday to today, we got the line chart. But again, closing price and the date which I said, which is the time frame here, can be variable. You can plot the line chart in 5-minute chart by using the 5-minute different data points, or 15-minute, 30-minute, any time frame. What you need is a different time frame and the two important data points. The moment you see the line chart, easily you can spot out which trend the market is presently trending. This is where exactly the use case of line chart comes in. Most of the media and newspaper use this particular kind of chart pattern to represent the overall market trend in a simple format. So it was about the line chart. Now let's move on to the next type of pattern, which is bar chart. It is a more evolved type of a chart comparing to the line chart, because in line chart we were comparing two data points from a different time frame, but here we are comparing four important data points, which I said open, high, low, close, from a different time frame perspective. So here, as you can see, most of the people call it as a bar chart and also OHLC chart because it represents the open, high, low, close at the same time. So as you can see, this is the single bar that I have taken to represent the data here. So basically we have four important data points. First one is the open. So this is where the market opened. For example, let's take an example of today, where the market opened. The moment you see certain price level where the market opened today, and you can also see that the closing price here, right? The moment you see the chart, you see the open and the close, and also till what price the market traded, that is the highest price, and the lowest price, till what price the market lowered at lower level. So these four important data points we get here. The first important thing we need to understand here, as you can see the horizontal lines here, the short horizontal line that represents the open close, and the high and low is not represented by any horizontal candle. So basically those are the highest extreme points which we can easily spot out by just looking at the chart. But the horizontal line just represents the open and close, and open will be always on the left side. For example, you can see this is where the open horizontal line is, and this is where the closing. That means closing always comes at the right side. With this data point, we can easily spot it out that the overall market closed in the positive note for this particular entire time frame. It may be a day, it may be a 5 minute, it may be 15 minute, doesn't matter. Just looking into some different time frame, we just look into the four important data points and we can easily plot the bar chart. Let me also show you how the negative candle looks like. For example, let's say this is where we get to know this is the high and this is the lowest point. Once we have that, we have the open price, and open always comes at left. So assume that market opened here and market closed here. So this type of bar indicates a negative sentiment or the negative closing of the market. Once we combine these bars in a series of bars, then we get the chart something like that, and it will also show some trend and different patterns over here. And by this we can clearly see that the overall market was trending upwards. Well, now let's move on to the next important chart type. Basically this chart is used by most of the technical traders and one of my favorite too. Let's move on to that, candlestick charts. As we saw in the bar chart or the OHLC chart, this chart also represents the OHLC open, high, low, close, but with a different graphical manner. As we can see, this looks like a candle. That's why it is called as a candlestick charts. This was invented by the Japanese. Now let's try to understand how to interpret the candlestick charts. As you can see here, let's now look into the positive note candle here. There are two important parameters or two important aspects you need to understand. One thing is the body. You can see the difference or the overall from open to close. If you plot some blocks, then we can call it as a body. For example, in this case, you can see from here, this was the open, this was the close, and by combining this, we plotted a block. So this entire block from open to close, it may be a positive or negative, that doesn't matter. The block which is plotted by using the open and close is what we can call it as a body of the candle. And next comes the wick and shadow. The difference between the close and high. You can see here the difference between close and high, or the body's extreme level to the total extremity of the market, where the overall market traded to the extreme levels. In this case, you can see this was the close and this was the high, and the difference between this high and close is what we can call it as a wick. So if it is an upper set, so then we can call it as a upper wick. And similarly, you can see here this was the open and this was the low. The difference between open and the low, the extreme lower level, so that we can call it as a lower shadow. I hope the basic structure of the entire candlestick is clear for you. So basically there is a body and there is a wick, so both indicates a different data points here. The block which is plotted by using the open and close, what we can call it as a body, and the remaining level from the close and from the open, that lines we can call it as a shadow or the wick. And similar to this, we have the negative candle here, so which means market opened at the higher level but closed at the lower level. When the market closes below the open, then we can call it as a negative candle. When the market closes above the open, then we can call it as a bullish candle or the positive candle. This is the beauty of this kind of chart. So basically it represents the four important data points of the market, and just by looking at the overall price, we can easily interpret what exactly happened for that particular time frame. And here also, when we combine the two or more candlestick patterns, we can easily spot out different repetitive patterns in the market, and technical trader just looks into that particular patterns and spot out which way the market is trying to move now and how I can align with that particular movement. Well, I hope you learned something valuable today. This is the beginning. We are going to upload so many other informative and educational contents on the trading. If you don't want to miss those updates, kindly consider subscribing to the channel and also click on the bell icon to get the regular update. The information that I have shared is for educational purpose only. It is not a buy or sell recommendation. Before investing or trading in the stock market, please do the thorough research, because stock market investments are subject to market risk. Well, this is it for today's video. See you in the next interesting video. Until then, take care. Bye bye. Jai Hind.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.